Welcome to our short guide on tax residency in Romania. Moving here offers new opportunities and challenges, including understanding local taxes. This guide simplifies complex tax jargon for expatriates, covering Romanian tax residency and reporting obligations. Whether new or optimizing your tax situation, this guide ensures compliance with local laws. Let's delve into the specifics of Romanian tax residency and what it means for you as an expatriate. In Romania, tax residency is determined by several factors. In general, you're considered a tax resident if you have a domicile in Romania. If your primary and permanent home is in Romania, you're likely a tax resident. Center of vital interests. Your economic and personal interests are significantly centered in Romania if, for example, your family lives here or your primary source of income is within the country. Physical presence. Spending more than 183 days within a 12-month period in Romania also makes you a tax resident. Government employment. Regardless of the duration of stay, if you're employed by the Romanian government, you're deemed a tax resident. Understanding how these criteria work is crucial for expatriates to navigate their tax obligations effectively. Determining your tax residency status will influence your tax liabilities, including what income is reportable and taxable and the taxes due. For expats, understanding the nuances of tax residency becomes even more critical if they are potentially considered tax residents in another country as well. When Romania has a double tax treaty signed with another country of which you might also be a tax resident, specific rules outlined in the tax treaty will determine your residency status. Here's a more detailed look at these considerations and the general rules applied under double tax treaties. When conflicts of tax residency occur, that is, when you could be considered a tax resident in more than one country, the applicable double tax treaty provides tiebreaker rules to establish in which country you will be treated as a resident for tax purposes. These rules aim to determine your country of tax residence in a way that avoids dual residency, thus preventing double taxation of your income. Here are the general tiebreaker rules commonly found in most of the double tax treaties. Permanent home available. The first test usually considers whether the individual has a permanent home available in any or both countries involved. If a permanent home is available in only one country, that country is generally considered the country of residence for tax purposes. According to the interpretation of the OECD on this article, a permanent home available can be either owned, rented, or any home that is always available for the individual to reside whenever traveling to the respective country. Center of vital interests. If it is concluded that the individual has a permanent home in both countries, then the country with which the person's personal and economic relations are closer, the center of vital interests, is considered the country of tax residence. This includes factors such as where the close family members regularly live, where the person is employed or conducts business, and where her most valuable assets are located. Habitual abode. It may be the case that the country of residence cannot be determined neither through the second criterion above, i.e., center of vital interests. This may be due to the fact that the individual has no close family, is not married, and has no children. Or family members are located in both countries. In such situation, the next criterion that must be considered is in which country the individual has an habitual abode. This refers to the duration of stays that may be more substantial in one country than in the other over the course of the tax year. Nationality. If a person has habitual abode equally in both countries, the individual's nationality will then be used as the tiebreaker. If the individual holds dual nationality or nationality in neither of the countries involved, the competent authorities of the countries involved will settle the question of residency through mutual agreement. Mutual agreement procedure. As a last resort, if all other tiebreaker rules do not resolve the issue, The tax authorities of the countries involved will have to mutually agree and determine the individual's residency status through a procedure of mutual consultation. According to the Romanian tax law, any non-resident individual who stays in Romania for at least 183 days within any given period of 12 consecutive months has the obligation to fulfill a tax residency assessment procedure. More exactly, they must determine their tax residency status in Romania by following a specific procedure with the Romanian tax authorities. The process generally involves completing a standard questionnaire. This is the questionnaire for determining the tax residency of individuals upon their arrival in Romania, and preparation of certain documents and information related to their personal status. The questionnaire collects detailed information about the individual's personal and economic ties to Romania. The supporting documentation must be submitted to the tax authorities along with the completed questionnaire and any other relevant documents or information that can help determine the individual's center of vital interests. Following the tax residency file submission, the authorities will review the submitted documents and determine your tax residency status. They will consider factors such as those already explained: your permanent home, center of your vital interests, and habitual abode, meaning the period of stay in Romania. For expatriates, it is crucial to accurately apply the tax treaty tiebreaker rules to determine the correct tax residency status. Misinterpretation or incorrect application of the tax residency determination principles can lead to tax reporting errors or slash and undo liabilities. Simply said, being classified as a tax resident means that your worldwide income is subject to Romanian taxation. This includes earnings both from Romania and from abroad. On the other hand, non-residents are only taxed on their Romanian-sourced income. Correctly assessing and determining your tax residency status can further help you in your financial planning and correctly fulfilling your tax obligations. Professional tax advice is essential for expatriates. Accurate calculations ensure precise tax liability assessments. Legal compliance keeps you aligned with Romanian tax laws, while tax optimization identifies strategies to minimize your tax burden. Consulting a tax professional is highly recommended. Key takeaways for expats in Romania include understanding residency criteria and implications. Be aware of double tax treaties to avoid dual residency issues. Conduct timely assessments of your tax status and seek expert advice for personalized guidance and optimal tax planning. Next steps for expatriates involve gathering documentation, assessing residency, consulting professionals, and planning compliance. By following these steps, expats can confidently navigate the Romanian tax system, ensuring a smooth and compliant stay in the country. If you found this video helpful, don't forget to like, subscribe, and share it with your network. Leave any questions you have in the comments below, and we'll see you in the next video.